Hi, this is Bob Lepine from Truth for Life with Alistair Begg. We're heard daily and weekends on Bible School Radio, 91.3 KDKR Decatur, Dallas-Fort Worth, and on 91.3 KYJC Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, one good reason to move money from your bank. Today we're going to take a look. Stay tuned for Prudent Money. Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know, I do appreciate it, and I do have a line open if you'd like to call in with a question or a comment. The number to call is 1-877-913-5357. 1-877-913-5357. You can also send an email to the Ask Bob section at the website, and I'll get it taken care of that way as well. A lot of ways to get information, all at the website, or giving us a call on the radio, 1-877-913-5357. Well, another day, another couple of good stories about something not so good that's happened with the bank failures. And it's interesting, some people are just kind of getting around, there's a bank failure? And so the news is slowly climbing, slowly getting to everybody about what happened over the weekend. Just as a reminder, we had two banks that ended up failing within 48 hours of each other. Signature Bank and Silicon Valley Bank. And it ended up being the second and the third largest bank failures in the history of banking in this country. Washington Mutual being the first back in 2008 during the Great Recession. So the question that comes up, and I'm getting them throughout the day, is, well, should I pull my money out of the bank? Is the banking system is stable? Is it going to be? It's going to be okay? Are we going to lose money on deposits? We talked a lot about that yesterday, so I don't want to get too far into talking about that because there's a lot of things I want to cover today. But I want to say this, is that thus far, it looks like with the biggest one, Silicon Valley Bank, it was an isolated incident. That bank is a very specialized bank. It deals with venture capital and startup technology companies, and didn't manage a lot of their banking arrangements very well, and got into trouble. And the problem with the bank, if it gets into trouble, is it can get into even bigger trouble quicker. And so there you have it. And there was the problem there. And if you're reading any about this in the news, of course, it's all very sensationalized. As far as the banking system goes, and I talked about this yesterday, I wrote about it today on my blog on the prudentmoney.com site, is that there is part of this that is somewhat of an isolated incident, being how specialized Signature Bank is. Not Signature Bank, Silicon Valley Bank. We'll get to that one in a minute. Silicon Valley Bank. But there is a underlying problem that could affect all banks, or most banks, and it's the bonds and their bond portfolios. We won't get into all of that, but that there is a underlying problem that could cause further problems. I don't think it's going to cause the kind of problems that derail the banking system by any stretch, but it could cause a lot of problems. Signature Bank, surprisingly enough, we don't have really any good information on this, which kind of bothers me a little bit. Now, remember Barney Frank? Used to be a senator and was well known during the 2008 financial crisis, during and after that, because he was one of the co-authors of a lot of the bank regulation. Well, Signature Bank pays him few $1,000,000 a year to sit on their board of directors. And he came out and he said, well, Signature Bank was, these are my words, not his, was kind of a victim in all of this because it went down because Silicon Valley Bank went down. I guess once a politician, always a politician. I think it's probably a little bit deeper than that because we'd had more banks go down and not just Signature Bank. But for some reason, a lot of the story on that bank is really not been discussed in the media, and we'll see. But the banking system's not failing, so do know that. But there will be unintended risks that pop up because of what the Federal Reserve Board has done, which is raise rates. First of all, they lowered rates during the Great Recession down to about zero and kept it at zero for way too long. Then they started immediately raising rates to fight inflation. And when you disrupt things like that, you have unintended consequences that pop up. And I think we still have that will start to manifest itself inside of the banking system, and I think we're getting a taste of it now. What's interesting is that if you'll recall, one of the things that came out of the Great Recession when the entire financial system almost collapsed, the regulators came up with what's called stress testing banks, a process that says, well, if this happens or this happened, will this bank actually make it? Or how would this bank survive this event if this happened? And from what I'm understanding, some of these things that are happening right now have not even been in the stress test. I was telling Tony Joe, who's on the program with me, the special Car Corner edition every Friday, but we were talking about this, and he said, it's just like electric cars. They have to be tested in so many different ways, so many different combinations of light being reflected from a certain car part to hit the sensors on an electric car, not so much electric car, a self-driving car, to make sure that self-driving car is built for every kind of possible situation. But you find out that the self-driving car is not, because it continues to have wrecks. But every time they have a wreck, they find out, we need a plan for that special event, for if that were to happen, that the car would go this way instead of running into something. Same thing with the banks, is that they're finding out now that maybe we should have been stress testing for other things as well and making sure that they were ready to go. So all that's going on. And then today, and it really surprises me what the market reacts to and what the market does not react to. And the market did not react to Moody's Investor Service. It's one of the three big rating services of debt. And they rate other things as well, the banking system being one of them. Moody's Investor Service cut its view on the entire banking system to negative from stable. It was making the move in light of the key bank failures that prompted regulators to step in Sunday with a dramatic rescue plan for depositors and other institutions impacted by the crisis. So that shouldn't be of any surprise because of what happened in the reaction from regulators, and it shouldn't be any big surprise what happened with the market today being up. The Nasdaq was up about 2.14%. Dow Jones was up a little over 1%, and the S&P 500 was up about 1.68%. The bottom line is the market loves a good bailout because it makes problems disappear. But like we found in 2008, once the bailouts started to come out, the market would react positively, and then the reality of the bailouts would kind of show itself, and then the markets would go down again. But all this points to the bond market, and this is why we've talked about this quite a bit, is that remember when interest rates go up, bond prices go down. and interest rates have gone up quite a bit over the past year to year and a half, and we've seen bond prices go way down. So if banks are holding a bunch of those bonds that are now worth a whole lot less than they were when they bought them, there could be a problem, and that's kind of where that problem stems from. We also had inflation news. It was kind of anticlimactic considering that we've had 2 bank failures since Friday. Inflation was up about 6%, no big deal. I still think it's dangerous for the notion that because of everything that's going on this weekend with bank failures and the banking system, that the Fed should back off interest rate increases. I think that's a very bad idea. Of course, I think bailing out all these depositors is a very bad idea too. It was a bad idea actually a bad idea back in 2008. In fact, I always wonder because here's what ends up happening is the government, maybe the idea of a bailout is not such a bad idea unless it's taken too far. And this is what they've done, and they continue to do is they take it too far. They took this too far. So, like I said, the market loves that, and even though it's not good long term, it does put a Band-Aid on the situation and kick the can down the road, which politicians are really, really good at doing. But inflation was kind of a non-starter today, up 6%, kind of what the government was expecting. And it's too bad they're not dealing with what the real inflation rate is, which I think it is a whole lot more than 6 to 8%. But that will probably never come out of government numbers. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. I do have a line open if you'd like to call in and join the program, 1-877-913-5357, 1-877-913-5357. You can also go to the website at www.prudentmoney.com. Send a question in, and I will get that taken care of for you. That's all at prudentmoney.com. 1-877-913-5357. This is Bob Brooks. We'll be right back.
The Word for Today is excited to announce the new official online home for the ministry of Pastor Chuck Smith and Kay Smith, PastorChuck.org. At PastorChuck.org, you'll have instant access to thousands of hours of verse-by-verse teaching by Pastor Chuck Smith from Genesis through Revelation, and full access to special messages on subjects such as prophecy and much, much more. Also at PastorChuck.org, a full library of great teachings by Kay Smith, and a section where you can read some of Pastor Chuck's books online, all free of charge. So visit the new official online home of the Word for Today and the ministry of Pastor Chuck and Kay Smith, PastorChuck.org.
In a time when we're prone to setting our minds on things of this world to solve the current crisis we're experiencing, let us trust in Jesus. He is the only one who can carry us through this confusion and unrest. We need to look more to God's Word, how it is properly taught for our comfort and hope. Please join us at 5 a.m. Saturday and 7 a.m. Sunday with Pastor Jason Wallace of Christ Presbyterian Church in Salt Lake City, Utah.
Or write Penfold Communications, P.O. Box 913, Layton, Utah 84041.
Hi, I'm Jan Markell, host of Understanding the Times. We're very excited to be a part of Bible School Radio. I hope you will join me Saturday, 10 a.m. for cutting-edge guests and the latest information to help you discern the truth, even the inconvenient truth. We'll help you understand our times and contend for the faith. That's Understanding the Times, Saturday at 10 a.m. right here on Bible School Radio or anytime at olivetreeviews.org.
Back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. 1-877-913-5357. Well, the regional bank stocks were hit hard yesterday because it's kind of one of those things where get the news, sell the stock, figure it out later if it was a good idea or not. But I don't want to be in this stock because I don't want the same thing to happen in one of the banks I'm invested in that happened to the two that failed. Because they don't talk very much about the stock, the shareholder, but for the shares should be theoretically worthless if you were invested in the company, in the bank. But so you watch the stocks, and this guy that I follow, he's an analyst, and he said, well, we can tell who the banks are that went to the emergency resource that the Federal Reserve Board set up to get money, because their stock price is way up. And the Federal Reserve Board, the Federal Reserve, set up an emergency resource type program for anybody who needed money to come get it and borrow it. And I think they have like a year to pay it back or something like that. There's an old saying that more money does not fix a money problem. And you might be thinking, well, how could that be? Because if I'm broke and you give me $1 million, that fixes my problem. No, the reason that you might be broke is because of your habits and your actions, which you'll just take to a bigger scale with $1 million and get back to the same place. It's kind of the theory behind it. Well, an interesting stock that I was following today, because I couldn't believe that, number one, they had dropped 45. The worst part of yesterday. Yeah, I guess it was yesterday. The stock was down 45%. At one point today, it was up of 11%. I didn't see where it finished up, but it was a stock that you wouldn't think would be a part of all of this. But Charles Schwab was kind of caught up in this regional bank mess. And someone asked me about brokerage accounts. Of course, a brokerage company could have a bunch of bond money market type or bond portfolios that support money markets. I guess if those went bust, that would take a lot, though, for that to happen. That could be a problem. But as far as your mutual funds and your stocks, they should be okay in any type of situation like that. But the CEO, Walt Bettinger, was out making sure that that everybody knew that Charles Schwab was okay, and it just kind of made me wonder what was really going on. He says that he told CNBC his firm is seeing asset inflows in significant numbers, meaning that everybody is putting money into Charles Schwab, and I guess he made it sound like it's all of a sudden. Why would that be the case? But anyway, he said that he bought 50,000 shares Tuesday morning for his personal account. So it just seems like it makes you wonder what's really going on behind the scenes, because there's always this, I call it with the government, emergency spin control, where they're spinning a story and they're doing their best to make you believe that this is really what's going on. Don't look look at what the right hand's doing. Don't look what the left hand's doing. Everything's okay. Just go back to sleep. Everything's just fine. And this is what this CEO of Charles Schwab seems to be doing. Maybe I'm just looking into it the wrong way, but he is definitely out doing tons of damage control, whereas your other banks are apparently taking emergency loans and just kicking the can down the road. I guess if there's a problem, we'll see it. First Republic, not sure why that one got into such trouble yesterday, but if I read this right, it was down at 1.85%. Surely I got that wrong, but that's what I thought I read. And I meant to double check that before I got on the radio, so there's my disclaimer. I could be wrong. But bottom line is, I know it was down around 60% at one point during the day yesterday. It was up 38% at one point today. I don't know where it finished. But the interesting notion, and we talked a little bit about this yesterday, is that the Federal Reserve really, what they did is they just said, if you're a depositor in any of these, either one of these banks, you are safe. We're backstopping up to 100%. Can't go above 100%, I guess. 100% of your accounts. Everything's going to be paid back. Even President Biden, I hate to even repeat these words, but he said taxpayers would not pay for any of this. Yeah, I don't know about that. But there's a lot of problems with the Fed coming in. And of course, they don't really say the Fed, they say regulators. They say FDIC is backstopping these banks. But I got a feeling it's probably more so the Fed printing more money. But either way, depositors will be made whole. And that just doesn't seem to bother people very. That's extremely unprecedented. And yet, 2 banks go down, and there's no risk for the banks and risk control for the banks if the Fed's going to backstop and cover all the 100% of the bank deposits. And like I said yesterday, there's that rumor kind of going around that if something really bad were to happen, that's what would take place. And I guess the system is big enough to hold it, but who knows? Mortgage rates, we've been watching that because it got up over 7%, which is somewhat of a key benchmark. Fell a little bit below 6% today, the upper 6 percentile range. And as we've talked about, the real estate market's kind of stuck, locked up. We need to get those interest rates back down to get that rolling again and people motivated to take out mortgages that are not so expensive. So what do you do in this particular situation? I said it yesterday. I think it's worth going back through it again. Just be smart about the bank that you're with. Make sure that you have confidence in the bank. I think you're probably, even though I'm not a big fan of the big banks, should I say safer with the big banks? But anything can happen. I mean, Washington Mutual was considered a big bank at one time. But if you're comparing, I've always been a big fan of the regional banks, ones that are very conservatively built, been around for a long time. Of course, that's what's caused problems. So what do I know? But I've still been a big fan of the regional banks. But I think from the standpoint of your investments and from the standpoint of risk, this just adds one more risk to the environment, because you just don't know what's going to, I always talk about there's the things you don't see coming. Nobody really saw these 2 banks failing. Nobody saw any of this really coming. Not a lot of people anyway. I think there were some that were writing about it a couple of months ago. But in fact, some ratings agencies I can't remember who they were. I'd heard this story a little bit earlier today. Gave both Signature and the other bank, Signature and Silicon Valley Bank, both very, very good, healthy reports 2 weeks ago. Go figure that. But from the standpoint of your bank, just you don't want to go do something rash like move money around unless you really feel led to do so. I don't think that there's anything going on that warrants that, unless you're very, very unsure about your bank. But like I said, most banks are in a little bit better, or in better situations than what we saw over the weekend. And make sure that your investments, that you understand the risk of your investments, because like I said, this adds just another risk to a long line of risks that the market has to overcome. Inflation still being one of them, even though we've gotten tame inflation numbers as of late, it's still an issue, and one that just does not seem to want to go away. And we're just starting to see the effects of higher interest rates. I think that's something that's the problem as well. So just be careful with how you're invested. Make sure that you are comfortable with the risks that you're taking. And I think that's always what you want to do, no matter what type of market or risk that we face. I've always said that managing risk is a huge stewardship principle, and something that you want to make sure that you have a strategy that you are managing for risk, and to make sure that you are not taking too much risk, that you're comfortable with what you're doing. And if you ever have any questions about that, you can always go to prudentmoney.com. Send me an email. I do answer all my emails, And I love to hear from you and what you've got on your mind. And we'll take care of and answer your question. Hey, this is Bob Brooks. If you ever miss part of the program, you can always go to your favorite podcasting platform and you can listen to the program. We do post at the end of the day, and I know a lot of people do listen to podcasts, and I appreciate that, because that's really a cool thing, that technology that's available to us to hear things that we weren't in the car to hear. So the radio show is on the podcast platform. You have your choice, and you can go check that out at your leisure. Hey, this is Bob Brooks. You got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.